Excuse me. All right, good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for January 2nd, 2016. Happy New Year. We have a market that is in sideways normal conditions. On an annual basis, using weekly RSI 14, we are in the middle of neutral at 51 out of 100. On a 10-day basis, using the 10-day NDX, we're right in the middle also of the 10-day trading range at 51 out of 100. Looking at the market mosaic, you can see the price with respect to the 200-day moving average is basically right on the 200-day moving average. It's a sliver just below, so that puts us in the middle of sideways. The slope of the 50-day moving average is white bullish at 0.18. ADX is a non-trending 15.3. The risk index is the 30-period moving average of the VIX divided by the 10. The threshold between risk on and risk off is 1.0. The current reading is 1.006. That just nudges us into risk on conditions. We take that score and compare it to the last 5,000 trading days. We are then able to find the average and standard deviation of that time frame and then compute the risk Z-score, which is 0.00. This histogram is a 90-day time series of that indicator, and you can see we've had two lower lows in the risk Z, and we are right at the zero line going forward. So this is a market that is an absolute center of the road, equally likely to go up or down with or without volatility. I mean, you're sitting right on the 200-day moving average. You're sitting right in the middle of the risk index. Had a flat year basically, long term. It's an election year. This is a market that is waiting for anything to start spooking the herd. There is no conviction anywhere. In the blended monthly rebalancing, the current holdings as of tomorrow is the rebalancing time, are going to be the Qs, real estate, and diamonds in ETF 13 and ETF 22. It is the Qs, technology, and then XLP, and that's ETF 22 and 32. In ETF 2, the theoretical exposure is at 15% or 50%, excuse me. The model portfolio is at 80%. Here's a quick look at the BMR ETF portfolios. And you can see that they are equally split between buying and cash, and that's both in the ETF 13 and the 32. And then in the ETF Max, just here are some things that I look for as a swing trader, where I'm looking for a continuation of large momentum moves in either direction among the price leaders. All right, so I'm basically using this screen to look at the 3-month and 6-month blended percentage, and that's how I rank these on the longer term. And then I'm going to go over here and look in the 1-week column, and what I look for are those symbols that are coded green or red on the basis of last week's performance. The ones in the green are exceptionally strong compared to the 1,000 or so ETFs in the database. So right now, the sugar sub-index, SGG, is the #1 on the blended percentage return, because it's returned 25% over 3 months, 19% over 6 months. That blends out to 23.74. And that puts it in #1 position. Over the last month, it's lost -2%, and that's in white, which means that is actually above average compared to all of the other members of the database. And then over the last week, it was up 1.11%. That's coded green, which means that compared to all of the 1-week performances of these 1,000 ETFs in the ETF Max database, sugar at 1.11% was an exceptional outperformer. Similarly, this pure sugar ETN at 1%, the sugar fund at 3.5%, Softs total return at 4.25%, Wilshire U.S. real estate the REIT ETF is at 1.60. So these are all symbols that have returned an exceptional return over the last 1 week. So there have been strong longer term and then had another strong week this past week, and therefore I would be looking for them to have continued momentum up or to have a sharp reversal in the following. And my belief is that the long-term outperformance yields more performance except when it collapses. And so the other thing that I look for sharp moves out of all these leaders. And another example, the solar energy ETF KWT was down 3.66%. So here's one that's in the lead. It's among the strongest in terms of blended percentages, but it had a sharp reversal this last week. So my hypothesis is that large returns come as a consequence of outperformance, and now I'm going to be prepared to play that increased volatility, the volatility of performance in either direction. So I'm looking for follow through in the solar. Now the solar is going to look either like it has cracked and there's more downside, or somebody's going to look at the 1 month and 3 month return and say, here's a chance to buy solar energy on sale. So if there's any kind of momentum play, a reversal from this sell-off, then that could be a nice sharp move as well. So that's how I use this chart essentially to identify some additional candidates. Here's another one, the Power Shares Clean Energy ETF PBW was down 3%. Is up 8% for the month, and so here's either an opportunity to buy PBW on sale, or the run is done and it's starting to collapse back to the mean. So I'll be prepared to bracket that in either direction, and if it's starting to move, I'll go in the direction of price. So I'm looking to use this screen to help me just identify some candidates that are likely to make large percentage of moves in either direction, starting with the from an overbought position. Now here's the same deal, but I'm looking at the S&P 500 here, and again I've got these sorted by the blended percentage. So Computer Sciences Corporation, we can see, is up almost 100% on a blended return over the 3 month and the 6 month. Over the month, it's in the red at 4%, 4 3/4, but it was a loser in the last week at minus 1.06. Now that's shaded yellow, which means that it is below average. It's between the database average and the average minus 1 standard deviation. So it's in that third quartile, if you will. Similarly, SanDisk and Amazon are both up in the green. Now SanDisk is probably up because of all the thumb drives that I bought this over Christmas in order to make the copies of the home study courses for the flash drives, but that's another story. So Google is up in the green. Google's nice here. It's green on 1 week. It's above average on 1 month. It's in the green on 3 and 6 months, and it's in the top 10 in blended percentages. So we know that technology has been one of the strongest sectors, and here's Google starting to steam north. That should certainly be on our short list going forward. Amazon is in the same boat, up 2% this past week. Yeah. So that's how I use that for the S&P 500 large caps as well. Next up, we'll take just a quick look at the market health check. Let me expand this just a little bit for you. Okay. All right, so the vertical blue lines are 10, 20, and 30 days worth of look back, and here's 40, 50, 60. The 30 and 60 I've highlighted just for reference. That's 1 month and 2 months. The horizontal purple line at 211 or 212 is the all-time swing high. That's been we achieved that back here in November. There was 1 test, 2 tests, 3 tests, 4 tests of that. Each one has been rejected, and we're on the last 2 days have been a rejection of that 212. We are right on the 200-day moving average, as we've seen. That's that shaded red area that I'm highlighting. The dragon is this dark shaded blue area. That's the 30-period Bollinger Band plus or minus 1. The floodplain is the Bollinger Band plus or minus 2. That's the lighter shaded blue. That red line in the middle is the 30-period simple moving average. That marks the middle of the river. That's the Bollinger Band mean. You can see price just crossed over it to the downside on Friday. This blue shaded channel here, the blue three-line channel, is the RAF regression channel 10-period. You can see the slope is up, but the price is below the midline. So we're buying at value if we're buying here. The black channel is the 30-period regression channel, lagged by a day. We're right on the regression line itself. So this is a market that is absolutely fairly priced on the basis of these short-term indicators and short-term price action. For almost 6 weeks, you can see we've been bouncing between 212 and 200, and the slope of the river is flat. The Bollinger Bands are narrowing, so volatility is drying up a little bit here. The slope of the 10 is up. The slope of the 30 is slightly down. Price is in the bottom half of the river. And so this is a market that is absolutely in the middle of this channel between 200 and 212. I think of this as the yellow zone, meaning that I'm going to wait to see which direction the market is moving intraday before I pick up a directional bias. I have no directional bias whatsoever. Now, were it to go below 203 and leave the river, start and get out here in the floodplain and then beyond, now we get into this red zone, and that's where I have a short side bias. Now, were it to get below the Z3 line, which is a solid red line, the Z3 is the 3rd-period Bollinger Band to the downside, then I pick up this solid red. Now I would have a very short side bias at that point. Now, the slope of the 30-period regression line is a proxy for the market's health. That's this sine wave. This is the slope of that 30-period. You can see in the blue dots is where that slope line crossed into the negative. The last time it crossed negative was on December 5th, and right now it is just below that zero line, around minus 0.10 on the slope value. That does not get to be an extreme down reading until it goes below minus 0.22, we know from statistics. It has to get above 0.40 to be steeply upward. So right now, this is a market that is in a sideways, choppy channel, drifting downward. The slope is slightly negative. It is just coming from out of overbought conditions when it got up to 208 and has pulled back, but it's at a fair value here, and so I have no directional bias. I'm prepared to shorten up my time horizon and be mostly an intraday trader until the market gets out of this sideways chop. I am going to let the intraday trade dominate my perspective, and then I will look to make money intraday, and then if it closes well, I'll look to leave a piece on overnight. But I am in no hurry to take on overnight risk with the market in this condition. I'm really waiting to see what this January effect is going to look like as we get New Year money recycling into last year's laggards. So I would actually expect to see some movement out of the U.S. and the large caps now, if we're going to believe that that portfolio rebalancing is occurring in January. So we'll be on the lookout for that. Okay, moving on. This is the ETF2 database looking at the regions of the world market model. And you can see that we have actually 4 of these symbols are on buy signal. This should read 40% recommended invested, 60% cash, with 6 on a cash and 4 on a buy. The market is in sideways normal. The S&P at 54 is slightly better than the globals of EFA at 48, so the U.S. is favored over the globals. Inside the U.S., the strength is in the Qs at 58, then the S&P at 54, and then a tie between mid caps and then the small caps. The two strongest sectors are technology and U.S. large caps, and the two weakest sectors are Latin America at 33 and then emerging markets. So that continues the trend of the last 6 months. Inside the sector spiders, the 9 subsectors of the S&P, strength right now is in technology and consumer staples, and consumer discretionary has not been all that bad either. Moving on. Looking at the world market model now. Again, we see the U.S. is all above average in the white, except the NASDAQ is exceptionally strong at 58, and mid-cap value is just below average at 47. China and Indonesia are very strong, Thailand very weak. Canada and Brazil very weak. Latin America very weak. The rest of the emerging markets in Mexico below average. Only Belgium is exceptionally strong in Europe. Germany, Netherlands, Austria above average. The strength in technology and staples that you see in the U.S. is mirrored globally as well. Commodities and oil continue to be very weak, and silver is lagging gold right now. Meanwhile, treasuries, corporate bonds, and U.S. real estate as alternative investments have been looking pretty good, and we saw that with that U.S. REIT ETF. So I'm looking for that to continue. The ETF top 30, using that ETF2 database, we're seeing the same kinds of trends. We have Indonesia, consumer staples and technology, very, very strong, as are the semiconductors and Vanguard's IT. So this is really a technology-dominated market right now. Moving on. Inside the Dow, I want you to notice that so this is the Dow stats compared against those 1,000 ETFs, so we get a sense of their power. And all of them are out of the red. We don't have any that are exceptionally weak. Even the worst condition one right now is Apple, and that's still only in the yellow in terms of strength. Walmart and IBM are yellow and red, meaning that they used to be red and are now starting to move up the equity stack here. Also, Verizon and JP Morgan are green and white. That's a good thing. Nike and 3M are decaying a little bit, as is Disney. But the real clear leaders, DuPont, Microsoft, GE, McDonald's, and Home Depot, Intel. I'm looking for those tech leaders to continue to lead into the new year. Just the average daily dollar volume stats for you. These are the ETFs that are the most liquid in terms of average daily dollar volume. The ones that are in the green under ATR percentage are the ones that are exceptionally volatile. So these are very liquid, very volatile, and therefore good trading targets during the day. Shifting over to the daily report now. Looking at the Dow Tactical Summary. Plenty of dojis. We have a channeling and an overreaction in Nike. We have a 551W here in DuPont. We have 4 symbols that test out well on the auto framer, better than 2 to 1. Disney, Nike, Apple, and Bank of America. It's only one RSI 2 value at 10 or less, and that's in Coke. So we have a few things to choose from. The ones in the auto framer are the most attractive to me right now. I would also be looking for DuPont on a follow-through play with that 551W. I like that pattern. In the ETFs, again, just a handful of dojis. We have one 5DD in silver. We have a 551W in treasuries, which was, again, a percent winner on last Friday. We have Brazil is number 1 in the max pain range compression, has an RSI 2 value of under 10. That's good. It's 7.6 to 1 on the auto framer, so that's going to test out very well as a swing trade frame that could be very volatile intraday as well. So I like Brazil a lot as a trading target. Here's the key stats on the from the auto framer for those of you looking to frame trades mechanically or swing trade one day at a time. And in the regression line fractal framework, the ones on the top shelf in the green are the ones that are the most numbers of ATR below their own 270 period regression line. Again, we use the 270 regression line as a price of long-term fair value. And these are the ones that are the most numbers of ATR below. So Apple right now in the Dow is number one. It's almost 4 ATRs below its 270 period regression line. Disney, Pfizer, Nike, and IBM, all of them are deep. Those are the top 5 deep value plays, if you will. Then on the bottom shelf, the ones in the red, these are the relative strength leaders. These are the ones that are the most numbers of ATR above their own RL270. So Procter & Gamble is almost 8 ATRs above its long-term fair value. So again, that can be an opportunity for a momentum continuation play or a reversion to the mean trade if he starts giving back enough of that leadership. These are the daily squeezes, and you read these. Excuse me. These are a two-part squeeze. Number one, these targets have been compressed on a daily basis, which means that we check the range from Friday, and it's less than 70% of the average range of the last 30 days. And so that's where we get this column here, range divided by average range, less than 0.7. So these are all very tightly compressed as a consequence of Friday's range. And at the same time, they have a large potential intraday move compared to the size of the range of the last 30 days. In other words, the range stat divided by the range risk is greater than 2. So this is one that has been compressed relatively tightly compared to the last 30 days, and yet has had a large enough range that a breakout from there could yield more than 2 to 1. And so the number one in that position is NSC. Number 2 you see is Brazil. That's a very favorable condition for Brazil. So we're going to take a look at Brazil and Apple here in a little bit. And we'll just flash through a few chart stats. You can stop that tape later if you want to study that further. What I want to point out on this chart, I like this this chart a lot. The top chart shows the Z-scores of 3 different regression lines: the 90 in red, the 30 in blue, and the 10 in black, or in blue, excuse me, thin blue. So you see how the 10 period tends to oscillate a lot. The slope of the 30 shows swingable moments, and then the 90 slows it down further and gives you something like a longer term market trend. And so this last 90 days here in the market has actually been pretty good. It's come from 185 all the way back up to 205. So that's a 10% move. And although it has not continued to go through, the overall trend is still valuable. It's gone from this -2 sigma all the way back into this river and then to the far side. And so this has actually been a pretty good 30-day performance, although it has felt very difficult indeed because of the large shifts in buying and selling. So where we stand right now is that the 30 has pulled back to the bottom of the river and holding. That's good for the long term. The 10 has held twice and is now rolling up. And the 90 is cooled off a little bit. It has rolled over, and yet there's still room for it to go. There's still another full 1 sigma before it really gets out of hand. You saw before it went from the 0 line all the way down to -2. It's just at +1 right now. So there's still room for this to get some momentum, break through this 210, 212 barrier, and then take off. And the 30 is well postured to support that. This sideways channel here has been an opportunity to gain some recovery and energy. Okay, that's everything I want to cover on the daily. We have time for just a few quick charts of interest. Okay, so we're taking a look at Apple here on daily charts. Um, Apple's in a very interesting position right here. You are justified in being short right here, um, with the idea being that the next support level is here at 103. And then if that fails, all you have left is this one long spike day. So Apple is about as weak as it can be. This is a really important support level for it to test. Now, conversely, there's a really nice rebound trade available here, where if this support level holds, then we're looking for it to get back to the RL270 here. So you can see this pink line is the RL270. That's long-term fair value. When Apple was priced up in here, you see where price coincided with the 270. That's a market in which the long-term estimate of fair value and the short-term price are in agreement. And then it had a sell-off from now the distance from the 270 to the 10. We use the 10 period regression line in blue as a proxy for short-term price. So that's the fair value based on short-term traders. So let's zoom in on this, and we'll see what kind of a trade frame we can get. We know that if it fails, there's little to no support below it, and it could definitely be in free fall. But if it holds, we would look at a trade like this. Let me get my pen. There we go. I would be willing to buy it above the high on Friday, and my targets would be really, I like this far side of the dragon, then the Bollinger Band mean, then a return to the 270 regression line. So that would give it a target of about 116. And so if we could get an entry about 107, that would give us nine points to the upside. If we want to insist on 2-to-1 reward to risk ratio, then that means we could afford to have as much as a $4 stop on this one for position sizing. That would take us from like 106.5 down to 102.5. So we would have this much risk compared to this much reward, and that's our 2-to-1 reward to risk trade. Now, what's interesting to note on Apple is that the dragon has come completely out of the river, and that's unusual behavior. I want you to note this little shaded area in here. You can see that is the dragon. That's the 10-period regression line, plus or minus half. The dragon has come completely out of the river, and that's unusual. So if we get this kind of a move, then a reversion to the mean is likely. The mean right now is at about 113. So we do have this much reward even on a reversion to the mean trade, then the longer term fair value right here. So I like Apple in this condition as a buy quality on sale opportunity. So we wanted to take a look at Brazil as well. Now, the nice thing on Brazil here is that it had such a nice tight doji, and here is that it had such a nice tight doji, and a return to the mean gets it up around 20, looks like about 23, and it's resting right on this double bottom. But you can also see that if it fails below there, there's no support below it. So I'm willing to get short on weakness and long on strength, because this is a perfect critical state. It's been horrible, and so nobody loves it, meaning that a lot of people have already abandoned it. And there's a very nice reward to risk ratio just to get back to the Bollinger Band mean. But if it collapses, it's a no-brainer to get short on it. So Brazil is in perfect condition for us. Let's shift over to look at something that's been strong, and let's take a look at U.S. real estate, or IYR. So this is what strength looks like on the other hand. All right, so this is looking back about 6 months, and you can see that we've had this nice upward channel. And if this channel holds right here like it has been holding, really then we can think about a price up around 80 for this thing to continue to climb to 80. Failure here takes it down. It's still in an upward channel as long as it holds above 72. Below 72, then that market has cracked, and then we can think about getting short. So there's a lot of good news. There's also some potential give back in that one as well. So that's a trade that can work in either direction. Let's take a look at XLK, which is that technology sector of the S&P. XLK is in pretty good shape here. Very little sell-off. If it holds support here again at the bottom of the river, at the bottom of the dragon, that's all favorable. Then the upside is up here around 45. And we have a 2-to-1 reward to risk ratio here. I like technology holding support here at you can see the fair value is this 270 regression line. It's right at fair value, and so the next logical move is up. If it were to be consistent, it's going to be this kind of a move. And again, we're looking for it to hold inside that channel. So I like that trade there. It has to get below 42 before we can think about shorting that one. Okay. All right, that's everything I want to cover tonight. We got a later start because of soccer, so I don't want to hold it up. I want to get this processed and hung. We completed the build on the 2015 research weekend in Kansas City. The videos and the presentations are all prepared now on thumb drive, and along with about 80 different trading lessons, about a little over 5.5 hours worth of the trading highlights from that week of live trading in Kansas City. About 80 different case studies and many lessons. That was a pretty good week for us. That was a 25 or 30-hour week. A lot of good insights recorded live and in the moment. Basically all the intraday techniques we use, how we frame the trades, how we think about reward and risk. And so both of those are now available, and give a pretty good demonstration of what the June research weekend in Kansas City is like. We've got another one scheduled to do in June of this year, and so the 2015 ones are now available. Information available on the website if you're interested. So that's everything I wanted to cover tonight. Take good care, guys. Have a great new year. Be safe out there. We got some bad weather coming through the Midwest. Be safe. Take care of yourselves and your family, and let's do well this year. Take good care.